So now I want to start introducing you guys to key concepts. And what we mean by key concepts is that there's typically one major piece of price action that determines a lot of the bias for the day, whether it's failing above a certain area, or it's breaking structure here, or it's an SNDR that breaks a key SNDR that's responsible for holding price up. Usually there's something major that happens every single day, and we have to not only use a little bit of our discretion, but put that into our trading strategy so that we're not on the wrong side of what the higher time frame order flow wants to do. So if we look at this day in particular, you'll notice we've had a major range that occurred here, right? So we have two decisions, right? Knowing that the market's either trending or ranging. We're either going to continue ranging, in which case we're going to fail above here, right? Or we're going to break the range, come back in, and then leave. Pretty simple. The third option, obviously, is that if we fail and then we begin a trend the other way, right? Completing a higher time frame double top or something of the like. So you'll notice inside of this range that occurred from midnight to about New York Open here at 9:30, that we had bullish structure internally, right? On our 15-minute time frame, this is what we use in the bullpen, right? For major structure shifts. We don't want to be along the 15-minute time frame. So we had this bullish structure. You'll notice here that we had a protected low on the 15-minute time frame. We traded up, body closure above here, traded back in, cool, traded up again, and then we attempted to break out of here. You'll notice that that candle closed inside of this range. Now that's a little bit important, but not as important as what happened here. So if we're going to continue this ascent, we should not break this protected low. As a result, we actually broke this. Now we're expecting any longs to be a retracement, as we now have a break of structure, and we're expecting further downside. Otherwise, this should have traded back into our prior zone, similar to what this candle did, and then we would continue trading up. So the market made a very, very key decision in this area here from about 10:15 to about 10:45 to break structure on the 15-minute time frame, right? If we zoom in on our 5, you see a period of consolidation. But if we zoom in even further on our 1-minute time frame, now we actually have this key area of interest, okay? This key intermediate time frame area of interest was responsible for breaking 15-minute structure. Now that's key because, as I said before, in this particular example, and you'll find this across many different days, that if you have that attempt that fails and you got a wick on a 15-minute time frame, usually you'll be able to take longs and now your target is above, right? For the 15-minute time frame, you would expect this low to now break that high. Instead, if we get a break of structure, now any longs we take, we have to have the expectation that this is just an intermediate time frame retracement, right? So those expectations of price are super important. Now, this area is extremely important because if that area gets broken, we don't go long or short based off of whatever the context is. In this case, because it was responsible for breaking structure to the downside on our 15-minute time frame, had this area broke, we wouldn't be looking short for the remainder of the day. This area remains intact. We're only looking for shorts for the remainder of the day, right? Now, that doesn't mean that we can't initially take our long as a retracement into it, but it does mean that our bias from our higher time frame order flow is now heavily to the downside. And if we zoom this chart ahead, you end up seeing violent retracement back in, as we would expect based off of the higher time frame, and then an immediate higher time frame shove, which then ends up continuing for the remainder of the day being heavily bearish. So just to be clear, this area should hold price down, and if it does, we're looking at a higher time frame movement downwards. That means a couple of different things. Number one, as our market structure diagram goes, we can look for that first movement back up to mitigate the zone and then continue on with a higher time frame. Once that movement is done, you're going to find it very, very difficult in a higher time frame movement to have any sort of long success, right? You're looking here, you get your stop run. You're looking here, maybe you get a little bit of a movement, but anything else, you're getting your stop run all the way down, right? Not only that, so we're avoiding taking unnecessary losses in the long positions, even if we're not able to take these shorts that end up continuing lower and we're quite profitable, right? But at the same time, you're also expecting that because this is a higher time frame break of structure, and now you're looking at the second move down, you're now looking for a major movement, and we're looking at a higher time frame objective. In this case, you've got your 4-hour or your daily low here. Once that's hit, you'll notice that it's actually quite a bit easier to now stock long positions for that retracement. But until that daily objective is hit, or that higher time frame objective is hit, which we're expecting because of the break of structure that happened here and the SNDR holding price down, that key area that gave us our bias until this objective was hit was short. And until that's done, now we can start looking for longs for the retracement based off of the diagram that we use so often. Going over a bullish example now, you'll notice we're in a major range after a large sell-off. Okay, can possibly look, we've got failure here, we can possibly look for a movement back up, at least into this zone, which we haven't tapped into yet. However, we're unsure whether we're going to actually take more liquidity lower. We haven't swept anything out in here really, so we can mark all these up. Again, we're leaning on allowing price to make a major decision and then following suit. For example, if this area builds an SNDR that then breaks, we then trade back in. We're looking at that area. If it doesn't break, we're going to be short for the rest of the day. Why? Because higher time frame order flow is telling us that we want to be short for the rest of the day. In this example, however, you'll notice that we end up breaking out. And we're looking at the area of interest that was responsible for that break. And you would look at this consolidation here as a result of that. So our expectation, now that price has tipped its hand, is that we have this area of interest that if it trades back into, we want to be looking long, right? And as a result of that, not only are we not looking short, right, as we're trading against the intermediate trend, you can take the first short if it presents itself, as that is high probability of that mitigation. However, for a high probability trading system, we want to be aligned with what the higher time frame order flow wants to do, right? So if we play this along a little bit, you'll notice we had a major tap back in where, to nobody's surprise, that area that was responsible for making a major decision, and that discounts all of our thoughts and process of, oh, maybe I want these lows to be swept, or maybe I want that one to be swept, or maybe this 8:34 time zone, or whatever the case may be. We have to react to what price is telling us. And we use these areas as major interest points for our bias on the daily time frame, right? Or at least an intraday time frame. Now, this movement ends up trading up. We would expect it to break and go higher. Okay. We would then expect price to return back down to it, right? Liquidating the early longs here. And then we would eventually have maybe a change in order flow, which would then lead us quite a bit higher. We're looking for some form of intermediate time frame failure, right? And if we zoom the day forward, you'll actually notice that there was that high probability short. We then traded back into here, leading another strong move. And obviously, in hindsight, the day ended up having many opportunities for some significant bullish positions, right? Whereas if we fought short, even if the short looked beautiful, it ended up not being profitable. Why? Because we're not aligned with our higher time frame order flow. Now, it bears in mind as well while we're reviewing these days for these key areas that we're not just focused on each individual SNDR. Right? For example, this area that ended up breaking above here, on a 1 minute time frame, that would be a break of structure. But we then ended up liquidating it, right? And you could assume that there's an SNDR that broke the SNDR here. That's fair. However, I want to make the point clear that we're not just looking for areas of consolidation that are responsible for something here. We're studying the key areas that are responsible for the major intraday bias. Right? This area was responsible for price wanting to expand to the upside. The prior example was the price wanting to expand to the downside. And until these areas break, we are heavily bullish or bearish depending on the context. Now I want you guys to have a look at this chart, and you can make the paralysis case where you've got this failure that's occurred underneath here. We've got a double bottom. Obviously, we traded up into our prior zone, which is now mitigated. We traded into the SNDR, cool. Now price has to make a major decision, right? So if I give you guys another couple of candles, right? We've now analyzed that price had to make a major decision here. Why here? Because we've now failed to go lower. This was the attempt to go higher. We've now broken out of our consolidation. We have a decision to be made. So if we trade back down to here and we find strength and higher time frame order flow wants to push us higher, it's going to come from here. Very rarely will you see this just blast off unless you have a real higher time frame reason for price to be done, and then we just wreck all these highs. In this case, and usually you see that trade back in to mitigate the range and then lift off. Instead, what were we met with? We were met with an SNDR that then broke below, coming back down for these lows again. That's very irregular, and it's also what we don't want to see if we're considering higher time frame order flow being long, right? So now if you pause the video and you have a look at what your expectations of price would be, whereabouts you would expect price to return to, what area you don't want to see broken should we remain short biased for the day, it's pretty clear to see. Now, if we go forward, you'll see that price returns back down to it. We have a little bit of a movement away. We then trade back up to it, finding more weakness, and sure enough, down price goes for the remainder of the afternoon, right? So it's these areas of interest that are responsible for something, not necessarily the SNDR, but what gives them power is how we view it in terms of the daily context. And you can, in hindsight, okay, great, this was just a bearish trend, why would I expect anything else? And that's true. However, when the higher time frame objectives are done, in other words, this higher time frame low, right, you've got a strong higher time frame move, we cannot discount the possibility that a major decision would be made here to break structure. This is exactly how that's formed. Instead, we were met with bearish price action. We have to react and follow suit. Had this lifted and we tried to short for the rest of the day because this was a bearish trend, we likely would have found nothing but misery. So we have to stay on the right side of higher time frame order flow, and in order to do that, we need to understand these key concepts, these key areas, and the price decisions that are being made inside of them, and then following suit afterwards.